Good evening, everybody. Good to have you back. Let's get started with this specific video. Little bit of a continuation from the last video, which was the difference between 401ks and Roth IRAs. I'm going to keep it relatively simple as well on this topic, which nobody likes to talk about or go over, which is taxation. And I'm going to stick with the Roth IRA versus 401k theme, mainly because the people I sit down with really haven't um, plan for retirement and specifically the tax burden that may come with it. So let's get started. Here's the outline. I'm going to go over the structure of what a progressive income tax looks like, particularly with each bracket. If you've seen my video on taxation history, I went over the original tax bracket from 1913 versus today. It's going to be similar to that because I'm just going to launch from today's tax bracket and then show you what this looks like in practical numbers and figures that you can actually calculate. And then I'm going to look at earning potential and those tax brackets after the structure. I'll use the structure as the framework for this, and then we'll just go forward. And then what income taxation will look like during retirement. And again, I'm going to compare the 401k versus the Roth IRA. There are other types of strategies and different accounts that you can pull from during retirement, but just to keep this simple, I'm just going to focus on those two because that's what I did speak about in my earlier video, the last one on 401k versus a Roth IRA. And this is going to be dealing mostly with traditional financial assets, probably the ones you're used to: stocks, bonds, mutual funds, ETFs. However, just to let you know, and this is going to be another video soon, there are companies right now that are looking to offer crypto assets with these plans, the same way other companies have offered gold and silver for these types of plans as well. So we're going to keep our eyes for the future, definitely, and I'll do a video on how to do that with the crypto assets as well. So going forward, this is what the structure looks like, and this is going to be the framework I'm going to use for the rest of these slides. So let's explain it from left to right. On the left, I have all the tax brackets from 10% to 37%. And then the second column is the income that is affected by those tax brackets. Now, this is not as easy with a progressive income tax as saying, I make 100,000 per year, therefore they slap a 24% tax on your 100,000 and call it a day. No. What they do is they bracket it to the point where you look at the bottom end of the bracket and the top end of the bracket, subtract the two numbers, and you're left with a bracket range, as I have in the middle there in pink. And that bracket range, that number, if we're maxing out our top end of income earning at each of these brackets, that bracket range is what you're getting taxed on. So to find the bracket range, you just subtract the bottom end of the income bracket from the top end of the bracket. And there you go with the bracket range, and you can find out your taxation liability. I'm going to use the top end of these brackets just for, again, ease and simplicity. I don't want to get too complicated with this, but just follow this structure because those last two columns of the taxable income and the taxes owed are going to be taken from the formulation that I'm going to do from that middle bracket range. So keep in mind that this is what it's going to look like, and I'll fill in the numbers as we go forward with this. And the first one I'm going to tackle is the second bracket, that 12% bracket, with $44,725 being at the very top end of that. I look at that number, 44,000 ish. It's pretty decent, normal entry level salary for someone just out of college going into the workforce. So I'm going to show what that looks like, and then I'm going to push them up to the other brackets as well to show you, you don't just start at an entry level, but you look for promotions and way to make more money. And I'm going to show you what that would look like at the higher levels for people who decide to make more money. So let's go to the next slide. All right, so here's a good example: the progressive income tax. How is it applied to a $44,000 a year salary? Well, that first bracket at 10%, what you're making up to $11,000, that is that bracket range, because I took 11,000 minus 0 on that first bracket. That's how I get the bracket range. That 11,000 in that first bracket is what's taxed at 10%. That's the taxable income, 11,000 times 10%, and then the taxes owed for the year, 1,100. Pretty simple math. Once you get into that second bracket, now you're starting at 11,000 and ending at 44,725. And when you subtract those two numbers, that is the bracket range, 33,725. That 33,725 is what's taxed at 12%. And as you can see, the taxes owed on that right column, 4,047. And then if that's the top line that you make and you're making an entry level salary at 44,725, add those two columns up on the right hand side, 1,100, 4,047. You come up with 5,147 for your total annual tax obligation for the income that you make. That's technically how a progressive income tax works, right? So look at this, soak it in, see the numbers, comment in the comment box if you have any questions about it or you're confused about it, because now I'm going to bump up to the next tax bracket of 22% if you were going to get a promotion, get a raise, and make 95,375 instead of your entry level salary right here. So that will be the next screen. 95,375 is now your income, which means now you are paying taxes in 3 brackets, not just 2. Same thing. Up to 11,000, you'll be taxed at 10%. Tax owed 1,100. We went through that on the last slide. The 12% bracket, that bracket range, 33,000, that's what you're taxed at 12% on the taxable income side. Boom, taxes owed 4,047. Now that you're in the third bracket, you're going to be taxed from 44,000 to 95,000 at 22%. That is a bracket range of $50,650. And when you multiply that by 22%, now you can see the tax liability is quite enormous in that third tax bracket alone. And most of my clients are in the 12, 22, and 24% tax bracket. 95% of my clients, I'd say. Probably the other 5% are in that 32 or above, but the bulk of them are in this. And as you're seeing with this, the more you make, the bigger slice that they take between that range of that bracket at 22% going forward. Now your tax liability for the year, when you add all those 3 columns up, is $16,290. And I'll do one more. I'll go to the top one, which is 182 in the 24% bracket to show you what that looks like. Now you're paying income taxes in 4 separate brackets. We already did the 10, the 12, and the 22. But now you've decided to scale up your business, do a couple side hustles. You have a family, you're trying to take care of them, and you've maxed out your income for the year at 182,000. Well, now that bracket range in that 4th bracket is $86,724, which means that $86,725, I'm sorry, is now taxed at 24% for a tax liability of just that bracket for 20 grand for the year. Add up all of those columns on the right, and you end up with a tax bill at the end of the year for $37,000 and change, which is about a little bit more than $3,000 per month just in federal income taxes. I'm not talking about state income taxes here. I'm not talking about Medicare. I'm not talking about Social Security. This is just the tax bracket for the federal government on your paycheck that you're seeing if you're a W-2 employee. Look at this, soak it in, boom shakalaka. I'm not going to do the other 2 because you kind of get the picture just looking at this. And like I said, most of the people I sit down with on a nightly basis are between that 12 and 24% bracket. And as you can see, they take a larger and larger slice as you keep going through this and keep getting more income that you're bringing in per year. So I'm going to give you kind of overall my problem with the progressive income tax system. It was originally touted as something that was going to bring egalitarianism to the working class, because the more money you make and the higher the income that you do bring in on a year will be taxed at a higher rate, and up with the proletariat and all that stuff. But that original income tax that was from 1913 didn't look like this. It didn't have brackets from 10 to 37%. It had brackets from 1 to 7%. And the very highest of those brackets were the ones that were taxed at a larger rate. But what I'm going to look at is I'm going to start with that $44,725 income, and I'm going to use that as our baseline. And our baseline is going to be entry-level salary. So entry-level salary, don't worry about the percentage income increase because there is none from 44,000 if that's our baseline. But we agreed that $5,147 in taxes from this progressive income tax system was, comparatively speaking, just the first 2 brackets. fine by our end. No big deal there. I would look at that and say, nobody likes paying taxes, but that doesn't look overly unreasonable if you're making 44 grand to pay about 5 grand a year in taxes. It's about 450 a month, maybe. Now, when you start to get ambitious and start to get promoted at work and start to do some side hustles and make more money, you don't want to stay at that entry level. You go up to the next bracket at 95,000. My main problem with this is that you're increasing your salary by more than double, 213%. But by doing that, your tax liability increases from 5,100 to 16,000 a year. That's increasing by 316%. So you're doubling your salary, but you're tripling your tax liability. The question that I would throw out is why? Why does someone making 95,000 have to have triple the tax liability as when they did as an entry-level employee coming right out of college? I've yet to hear a good answer for that. But you keep applying that notion and keep applying those questions of why. If you scale up, have a family, and you're making 182 grand, you've just quadrupled your income from your entry-level salary at 400%, but your tax liability went up to 720%. Keep going and scaling up. 231,000, you're probably raking at this point. It would seem so, particularly since, and comparatively speaking, to when you got out of college making 44 grand, you've just quintupled your income, 517%. But look at your tax liability by going up 517% in income, 1,747%, from 5 grand in taxes a year to 90 grand in taxes a year, or 89 grand a year in taxes. And then God forbid you want to go make, close to 600,000. This is probably where you have a business, multiple revenue streams. Maybe you're into, I don't know, yacht sales. Maybe you're into sales management. Who knows? There's a lot of things that could pay you that high. Medical doctors as well can make that high if they hustle a bit. Making that kind of income from your entry level, you've just increased it 1,293%, but your tax liability increased 4,106%. Now contrast this to maybe a flat tax at 17%, right across the board. Everybody feels the same tax pinch at 17%, regardless of how much they're making, or even a consumption tax. I know that has been bandied about as well. I think either one of those two things would actually work better than what we're seeing right here, which is the big two problems I have with this. One, it punishes ambition. Simply because you want to get promoted at work and take on more responsibility and enhance your skills and enhance your career, that puts money into your pocket as a reward, but money taken out of your pocket as a punishment. So it's a mixed signal right there. You're trying to make more money, but you're getting punished for it by getting a higher percentage of taxes taking out. And the other thing it rewards poverty, particularly for those on fixed incomes, as we're going to see when I do the retirement slides and what your tax liability looks like at retirement. You pick a number that you feel comfortable with bringing in on a monthly basis because you're not working and you have retirement income, and you have to keep it at that level because the more you push it up above that level, like let's say you want 70 grand one year and 115 grand the next year for whatever reason. Nobody's fucking business why you want more than 70 grand on year 1 to year 2. But in order to do that, you'd have to pay a larger slice in taxes in order to incur that income that you would be getting on a year. Not good. It keeps you to a point where you have to stay lower just so you avoid getting raked over the coals. It's possible, as I mentioned, the consumption tax or the 17% flat tax, it's possible in the future that blockchain technology will, automatically process that to where whatever you're making, 17% comes off, or whatever you're consuming, that comes off, and we can take out the middleman known as the IRS, because I don't think anybody imagines an IRS agent as a public servant, even though that should be their main focus and goal and duty and responsibility. When you see complex stuff like this and all the things you have to fight for and all the things you have to do when you're audited, it could see why that middleman making all that money from their ridiculous budgets that they keep getting increased to and to the tune of billions of dollars is not exactly a good way to go, at least for those who enjoy freedom the way everybody else does. So looking at this, the tax liability with a progressive income tax has never been apples to apples and oranges to oranges. But here we're seeing in real numbers with their real brackets and their own figures why that is the case, why you're increasing your income, but in exponentially increasing your tax liability. So what does this look like in retirement? Well, I'm going to compare 401k taxes to Roth IRA taxes. And look at this just from let's start with the 401k. If you have a 401k, if you saw my last video on the difference between a 401k and a Roth, the 401k isn't the investment vehicle. The 401k is just the shell and the umbrella that you put assets in to defer and delay taxes until you're retired. So you put pre-tax money into a 401k account into whatever asset you're investing in. By the time you're ready to take distributions and cash out some of that for income in retirement, that's when they tax you. And, based on the tax brackets today, those could change in 10, 25, 30 years, who knows? But this is what it would look like. If you are pulling out $11,000 and you can live on $11,000 from your 401k, that's $916 a month in the 10% tax bracket. The monthly taxes that you will owe will be $92 a month. Let's say you want a little bit higher lifestyle than the 11,000 and you decide to pull out up to the top of the next bracket, which is 44,725. At the 12% bracket, that's about $3,700 a month in income. You will pay $429 per month plus the 92 that you're paying on the first 11,000. So every time you go up a bracket and you're taking money out of your 401k, you have to keep adding that monthly taxes owed line on the right-hand side to the next one. So if you're taking 95 grand out of your 401k at the 22% tax bracket, which is about 7,900 in income a month, you're going to be paying 1,300 there plus 429 plus 92. So add those three together, so on and so forth. If it'd be nice if you had a couple million in there where you could take a decent amount out on a yearly basis or a monthly basis. And with inflation, you're going to have a couple million in there down the road. But just remember that with a 401k, it's going to be taxed as income on whatever your income you're living in and living on when you're ready to retire. You will determine that number based on your own lifestyle and your expenses. But just know that the tax liability is coming with a 401k that you might be putting money into. Now, contrast this with a Roth IRA, which is after-tax money, meaning your take-home pay that you get, you can put into investment vehicles and assets in a Roth IRA. And the beauty of that is, regardless of how much you live on, regardless of what tax bracket you're in, if you're pulling your income from a Roth IRA after age 59 and a half, the tax liability that you have at the federal level is zero. So nice place to be in when you're looking at that. I think everybody would go for that plan and want to put as much money as possible into a Roth IRA. Most of the clients I sit down with do not have a Roth IRA, and I help them through that process on how to set that up and what assets to invest in by making a plan per month, putting into these assets. And then, by the time you're ready to withdraw that income during retirement, whatever age that may be, you do not have to pay any income taxes on the money that you draw out from the Roth IRA. Now, what's probably going to be most common for most people when we get to retirement is probably a mix of the two. So you might pull some from a 401k, you might pull some from a Roth IRA. All right, so let's look and see what that happens. And we'll do that for the first two brackets, the 10 and the 12% bracket from the 401k, and then whatever other money you want to pull out from a Roth IRA, what that would look like from a tax liability standpoint. So let's look at the mixed accounts. So let's just say on the left-hand side, we're pulling out up to the first and second bracket from the 401k, 11 grand up to 44,725. That's the top of the second bracket. Well, obviously, if you're pulling money out of your 401k in retirement, you're going to be taxed all the way to the right hand, $92 for the first bracket, $429 for the second bracket. Add those two up, $521, because any other income that you pull out after the 401k is, let's say, 44,725 is what you pull out. If you pull out any other income from a Roth IRA on top of that 44,000, you don't have any income tax liability. So you could pull up to 95, you could pull up to 100, pull up to 150, 180, whatever the case may be. Thinking in terms of what do I pull out of the 401k, I have to pay taxes on. Anything above that from a Roth IRA, I do not. You can actually set up, forecast, and plan your tax liability along with the income that you'd be pulling out of your accounts. Soak this in, try to realize it, think about it, because 99.9% of the clients I sit down with do not think about what they're going to be doing in retirement and what their liabilities are going to be, especially from a tax end. So let's get an even better retirement income, from the last one. Let's say you only pull out for $11,000 from your 401k. So let's say if you look at the 10% tax bracket, you pull out $916 per month from your 401k. 92 of that $916 at 10% will go to your tax liability. And then everything else that you pull out comes from the Roth. Your tax liability goes to zero in those brackets. So if you have a $150,000 lifestyle, you pull the first 11 grand out in the year from your 401k, pull the other 139,000 out from your Roth IRA, boom, your monthly tax bill is $92. That's a good way to actually mitigate it and at least think about getting it into these levels, because chances are if you have both a 401k and a Roth IRA, you're going to be pulling money out of both, theoretically when you're retired. So looking at this and the last slide, soak it in, think about it, and then think about the next questions I'm going to ask you. There's three main questions I'm going to have where I'm going to end the video on. Question number one, do you happen to know what you are currently contributing to your 401k versus your Roth IRA? Is it a fixed dollar amount? Is it a percentage of your income, pre-tax and post-tax? Is it you're putting into one or the other? Maybe you're putting money into zero and neither of them. Start thinking about that, at least on this question, at least on this level. And if you have a financial advisor, have they explained any of this information on taxes during retirement to you? And if they haven't, can you ask them why? And if not, do you feel comfortable on your own making a plan based on contributions to one, the other account, or both? Maybe it's your income percentage and what income you're going to need due to inflation by the time you're ready to retire, 10, 15, 20, 30 years from now. Looking at this and just trying to soak some of this in, these are important questions that I ask my clients. I have to ask my clients very uncomfortable questions sometimes. I will have videos on uncomfortable questions, which you can write down and answer on your own. You don't have to show anybody or share with anybody, but just know that a good financial advisor is going to ask you these questions to start having you thinking and steering in this direction, because it's just something that, again, we're so caught up in our day-to-day and our month-to-month on the grind, taking care of the things we have to take care of. We don't think about, we can plan for the future in a cursory aggregate level, but never the details sometimes we don't look at. So my goal at the end of the day is to make you look at the details. So hope this helped. Hope you found value in this. I will have other videos similar to this showing what to invest in or what you could invest in to get to some numbers for that income coming in, up to and including there are probably some companies that are going to start opening up to having crypto assets put into this, so you can actually think in this direction as well. So hope this was valuable. Giant hugs.